Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on September 19th, 2022. A reminder, we have a trading session, not this week, but the next. We're trading via alert this week after the Fed meeting, which concludes on Wednesday. Let me go over the results from our trades from last week. And I want to bring those results uh, into a different light. I want to take a look at them because of the upcoming Fed announcement. So last week, two new trades, closed trades. Devon, the trader's desk. The trade desk was actually the previous Friday, but it sort of fit in. It was this weekly expiration. We had a net return of 0.4%, but because of the length of the trades, the annualized returns were very, very, very high. More importantly, we rolled a large number of positions, generating significant amounts of cash, which is all why we're here. And you can see as you go through the numbers, the absolute returns were very, very, very high, in part because we rolled a week past the Fed announcement. These positions were rolled not to this coming Friday, but to the Friday afterwards in case there's any turbulence in the market after the Fed reveals what it's going to do on Wednesday. And so last week to goal, we had a very cash-rich week. We had an annualized return, our cash rate of return on capital of 41%. And this is how it breaks down between the new trades and the roll trades. And as I said, I'm going to get to those Devon and trade desk trades in a moment. So last week, the market did not like the CPI numbers during live sessions. And in answers to email, one of the things I did say was I've never seen a reaction to a CPI number that way. And the issue for me was I was surprised that anybody on Wall Street, anybody in the bond market would be surprised because the high CPI number translates into, oh my God, the Fed is going to raise rates 3/4 of a point. I thought they were going to raise a half a point. And now there is a conversation going on, will they raise a full point, which I don't think will happen, or what will happen in October when the market was assuming, many in the market were assuming it would be 0.5%, and it's probably now going to be 0.75%. The importance of the Fed cannot be overstated because on Friday we heard very good news that the rail strike had been averted, probably for a long time, if not permanently averted, that there's still negotiations going on, but everybody agreed not to strike and let's keep talking and we've agreed in principle. But the market didn't react. The market went down, which means the concerns about the impact of the economy really were completely overshadowed by concerns about interest rates, which means there's a lot of algorithmic and robotic trading going on between the bond and the equity markets surrounding the Fed announcement even more than is typical. And also mortgage rates ticked up above 6%. Depending on your age, 6% sounds good, but depending upon when you wanted to purchase something, if you wanted to buy something 2 years ago, interest rates have doubled. Now, the Fed really adds a significant uncertainty. And for those of you who haven't listened to these updates before or followed the Fed hits the bond market, okay? And a 1/4 point move doesn't seem like a lot, but when you have 3% interest rates, a 1/4 point increase is a 12% increase in terms of the value, the potential value of the underlying bond. And so when the bond market gets something wrong, or just a small percentage of people in the bond market get something wrong, it hits the stock market. And my belief is that on Wednesday, markets are going to react based on the language used by the Fed. Is it going to be dovish? This might be the last time we have to do 3/4. Is it going to be hawkish? We're going to keep going as much as possible, and it may be even more aggressive than we've said in the past, or will it be neutral? Typically, the Fed has muted any changes in language, meaning it's given the market hints, but it's never slapped the market upside the head. But in Options Income Blueprint, we trade around this. We don't freeze up. We don't stop. We have a market neutral approach, as you saw in the rolled cash numbers. Those are positions where we may be underwater at the moment, but the bottom line is we're still generating very, very, very large amounts of cash with very, very high annualized rates of return. Now, this trading uncertainty does not change, and this is where we're going to get to Devon and the trade desk. It doesn't change your companies. right? The Fed raising rates impacts obviously some companies, but in your bullpen, in the group of stocks that you choose to own or slash own and trade in a given week or in a given month, that pretty much movements in the bond market don't change that. So uncertainty concerning equities going forward had us trading a commodity stock, Devon Energy, a fracker, because the relationship of oil and the dollar, there is one. But more importantly, commodity prices and oil prices, fossil fuel complex prices, are often immune to what is going on in the Fed. We also closed the trade desk because it is an inherently volatile stock, an inherently volatile option chain. And while it's a terrific market leading company with an increasingly unassailable moat around its brand, it's still speculative based on valuation. So Devon Energy, it's a big fracker. It has the flexibility, and this is very important when you're looking at the fundamentals of a company, of opening wells and oil fields based on oil price forecasts. And traditional Chevron, what have you, oil field in North Africa or in the Southwest or whatever, you build a facility, you have a power plant, and you pump for 20 years. And offshore, it can be even more. Frackers move every 6 months in the nature of a fracked field. And so they have a lot of flexibility in opening wells. And recently, the oil industry, including the frackers, have decided oil prices are going to stay high, which means they're going to pump more oil, which means Devon's going to make more money. And so it is at the fundamental level, not tied to Fed uncertainty, and based on historical trading, a stock such as Devon does not necessarily move in any way as abrupt as other stocks when the Fed announces. So we sold Devon on the last week, $67 put, and then we closed one day later. A rarity. We don't do that too often. It's not a day trading service. But take a look at the numbers. We sold it for $53 a contract. We bought it back for $13 a contract, $40 a contract in a 24-hour period. So that's a 0.6% absolute return, but it's a over 100% annualized return. And for those of you who knew, 100% annualized return doesn't mean you're doubling your money. It means that if you did this trade based on the number of days you were in, that's what the return would be, and that's how Wall Street measures the efficacy of a trade. And someone asked, could we just do it by week, which is the way we did it the first 5 or 6 years of the service. But then members said, no, we need to use the calculation that Wall Street uses, which is, they said, more appropriate. Sure, why not? So even if you calculated that you only did this trade once a week, you would have a 31% annualized return. And why close it? It was not based on the upcoming Fed announcement. We picked it in case we had to stay in the position because of the Fed announcement. But we did it because of math. You make that kind of a profit in a day, you close. You just get out. It exceeded our 0.5% absolute return threshold. It's just time to leave. Doesn't matter if the trade's on for 4 hours or 4 days. You go. Now, the trade desk is a market leader in something that may seem obscure to you. It is by far and away the market leader in what is called programmatic marketing automation technologies. It's a mouthful. It's a company that uses very sophisticated computer software and artificial intelligence to tell the maker of a product, an advertising agency, the Avis Rent-A-Car, wherever, where to place your ads. Now, that was simple 50 years ago, CBS, ABC, NBC. Now you have 1,000 streaming channels, cable channels. You have 50 streaming services, and you have phones, you have laptops, you have smart TVs, you have smart TVs for Google, smart TVs from Roku. There's a myriad number of places to place your ad, and this is the most important company by a wide margin in helping people advertisers place those ads. Excellent earnings, which surprised the street, extremely volatile stock. And we only trade the trade desk because it's so volatile with what I call here silly puts, where the strike price of the put we sell is at least 10% out of the money if the trade is going to have an expiration date less than 2 weeks out. So here's the trade. On September 9th or Friday, we did this via alert. We sold the put, and we picked up $38 per contract. Now, we spent a bit of money, and we closed it for a modest profit. of $12 a contract. And it's a low rate of return. It was 0.2% rate of return, and it was 10% on an annualized basis, which is still, 3 times the average dividend yield. Why did we do this? Why was TTD closed? We closed to avoid having to roll it or close it with a loss. I was afraid of a Friday sell-off, which did not happen in the stock, but did happen in the market. It's so volatile, knowing this going into the trade, that you have to be flexible, not necessarily stick to rigid goals and close, especially in light of the Fed announcement. And proof of the pudding is, take a look at this chart. We're in a period of just a couple of days. This is the 5-day chart. The stock declined 7.4% from that top at the top of the arrow to the bottom, which is why, of course, if you remember, we sold a silly put, which is 10% out of the money. You have these very broad trading ranges, and it's something you really keep in mind. So we closed the position. In light of that, we still made a profit. And we get to live and fight another day with that capital. We're not tied up in the market when the Fed makes an announcement with an extremely volatile stock. And if you're saying, well, we only made $12 on that trade, and we made X amount of dollars we made $40, in the Devon trade, but look what we generated in terms of rates of return by rolling out 2 weeks, getting away from the Fed announcement a little bit. Bank of America, Citigroup, General Motors, Marvel Technology, Pfizer, and Charles Schwab. These are all market leaders, fabulous companies, and we generated significant amounts of cash. We don't have to be concerned about having to jump in and manage the position on Thursday or Friday of this week after the Fed announcement. We gave ourselves some time while we were generating these extreme rates of return. So trading this week, not too much is going to happen before the Fed announcement, 2 o'clock on Wednesday. And it is uncomfortable waiting for an exogenous event where there could be a surprise. But this is not going away. The market can't figure the Fed out, which is kind of surprising, in that the Fed has said what it said, which is we're going to continue to be aggressive in the face of very high inflation rates. Now, at the risk of boring you a little bit, right now, real interest rates are negative, and a real interest rate is the nominal interest rate. So let's say it's 3% and inflation is 6%. You actually have a negative interest rate of 3%. Now, the target for the Fed is not to get us to real interest rates that are positive in a short period of time. That would cripple the economy. But we're headed in that direction. And historically, the real interest rate in the United States, Treasury bills, is about 1 to 1.5%, not the rate you see posted on a billboard. And to conclude about the Fed, the most important thing that we'll see on Wednesday is not the rate. The bond market, which I agree with, is saying that about 90-95% of people in the bond market think it'll be 0.75%. It's the language. Will it be more hawkish or will it be dovish? Couple of announcements. We have a program called Income Madness. If you are in the master's program, of course, this is part of your program. It runs from Tuesday the 27th to Tuesday the 4th. We do live trading every single day at noon, and traders can expect rapid trading, 12 to 20 positions. We manage all trades via alert even after we conclude our live trading sessions, and there's a link if you're interested. It's interesting to call trading in a market at any time fun, but this is fun. We make money. We have target rates of return of 1.5%. We often hit it, often go above, once in a while go below. But just a heads up, in case you don't read this in the literature, if a position is still open and we're underwater, for example, at the end of the trading session, we trade it as part of the master's program, so I don't take unnecessary losses. Because the chart goes against me, I don't close a position. We stay until we're break even or profitability. The other thing is this Millionaires Trading Club. Great time, Las Vegas, in October. It's a unique series of seminars / coaching sessions, and not just myself, other people, published by Traders Reserve. And it's coaching in that I'm going to be going over fresh material that wasn't there last year, if you were there last year, including a refresh of the whole thing about investment pods and structuring your portfolio around target rates of return based in turn around your acceptance of risk. But we also trade. So we're going to live trade during these coaching sessions, and theoretically, one contract, two contracts, we get in and out, and you should be able to pay for the program. And there again is the way to get more information. The thing that may be of most interest to you is a brand new session on trading contrarian stocks, and meaning not contrarian against what I believe in the fundamentals, but contrarian in the current view of Wall Street. This is Michael Schulman. Thanks for listening.